What's up, people? Welcome back to Invest with T-Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So back for another video on ChargePoint. They held their earnings call this past Tuesday, and the news was better than expected from a revenue perspective. The stock is up $23.37 this week. Part of the reason is tied to the earning results and guidance ChargePoint gave. The other reason has to do with the relief rally the broad market is currently experiencing. But there is reason to believe that there could be more upside ahead for ChargePoint, despite the fact that quantitative tightening from the Fed kicked off this week. So in today's video, I'll go over the highlights and the main takeaways from the earning call, then cover where analyst ratings now stand post-earning call, and wrap up with some information that does strongly suggest the market believes there is more near-term upside for the ChargePoint stock. How much more? Well, stick around and we'll get to it. As always, I'd recommend watching all the way through so that you don't miss out on any pertinent information I'll be sharing. Drop the video an early like if you haven't already, and hit that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. So how did ChargePoint do this quarter? The first thing that Morse article like this one here touched on is that ChargePoint missed on their EPS or earning per share. They'll point out how the performance was worse than expected. Indeed, EPS came in with a loss of 21 cents versus the expected analyst consensus of a loss of 19 cents. Their gross margin also shrunk on a quarter-over-quarter basis, which is primarily attributed to the supply chain issues caused in big part by the COVID lockdown in China. That said, everything is about context. We have to remember that ChargePoint isn't yet profitable, and as such, the main things to focus on are cash on hand, cash burn rate, and revenue growth. As of April 30th, they are sitting on $541 million, right? This means that with the current cash burn rate of $74 million per quarter, they could technically operate for the next 7 quarters without any revenue coming in. And if that were the case, that would theoretically take them all the way to Q1 2024 before they run out of cash. Now, the reality is supply chain issues won't persist forever. China lockdowns are now lifted as of June 1st, and their cash burn rate is more than likely going to slow down on a go-forward basis. Revenue will continue to rise with EV adoption increasing, and eventually they will turn cash flow positive. And by the way, that's coming sooner than you think. There is reason to believe that this will be the case when you consider that they have achieved, as reported, a quarterly revenue increase of 102% year over year, reflecting momentum across all verticals. They not only exceeded the guidance they gave last quarter, they also came in above analyst expectations here by $5.58 million. Let that sink in. Now, part of the reason they were able to achieve this, they've been placing a ton of focus on growing not just in the US, but also in Europe. That is clearly paying off with a reported revenue growth of 67% on a quarter-over-quarter basis, and 57,000 of the total 188,000 chargers ChargePoint now has in service are located in Europe. For context, the last quarter they had 51,000 charge ports in Europe and a grand total of about 174,000. Beyond that, we know that their customer base is continuing to grow. They touched on the Volvo-Starbucks partnership I mentioned in my last video. You can catch those details here if you missed it. Ultimately though, what I was most interested to hear about was their forward guidance. After all, tech giants like Microsoft just this week cut their forward guidance in light of the challenging environment we're in. Well, ChargePoint not only reiterated the full year guidance of $450 million on the low end and $500 million on the high end. Again, for full context here, if they hit the midpoint guidance of $475 million, this would mean a nearly 100% year over year growth in revenue. Again, that is just massive. But that's not it. They also dropped this bombshell here. Take a listen.
We expect gross margin to recover through the rest of the year from 3 main factors. First, fewer supply constraints for mature products. Second, continued technology-driven margin improvements for our newer products. And third, continued efforts to pass on higher component costs. Demand continues to be strong as evidenced by our revenue outperformance and higher backlog, and our price points continue to be well received by the market. To summarize, our key margin challenges remain on the supply chain side as we continue to work with vendors to ensure continuity of supply and to get back to a more normalized product mix and mitigate increased costs. We are confirming our annual guidance given in our last call, and we remain committed to being cash flow positive in calendar 2024. With that, I'll turn the call back to the operator for Q&A.
You heard that right. They're targeting calendar year 2024 to be cash flow positive. That's only 2 years away. I don't know about you, but personally, that gives me high confidence. Now, switching gears and jumping into analyst ratings, not all have been updated, and therefore these numbers are based on 10 ratings only versus the 12 we had a couple of weeks back. But either way, as of this Friday close, the consensus analyst price target did drop to $19.05, which is still good for almost a 31% upside from current level. Not bad considering how far we've come already. The high end of the spectrum comes in at $24 and the low end of the spectrum at $12. So as it stands, I'm personally looking at the low end of the spectrum as my trigger point to be buying hand over fist. You'll notice that the split for these 10 ratings is still 6 buys, 4 holds, and not a single sell recommendation, right? That is a massive vote of confidence, again, in my opinion. So when I look at all this and I put it together, I would say that ChargePoint had a great earning report with all things considered. Analysts are fairly bullish on the stock outlook, but you don't get a nearly 25% move to the upside in a week unless professional traders with market moving capital get behind the stock. And here's what I mean. Take a listen.
Scott, this is one that Pete and I have each been talking about for weeks, ChargePoint, CHPT. They have been coming in here time and time again. This is the biggest today, though. They bought 90,000 calls out there just at the 15 strike with the stock at $14. That's one of the biggest trades in equities that we've seen in a long, long time. I really don't know what's behind it, but as a surfer, I just kind of run with that wave and try to get on it, Scott. So I'm on ChargePoint.
All right.
Well, what's behind it is everything I covered a couple of weeks back and in today's video. With an expiration date of July 15th on these stock options, as long as the stock price is at or above $15 on that day, traders will have a nice payday. Now, this of course means that between now and then we could overshoot and sell off a few times as people take their profit. Whether you decide to enter here and average down or wait it out a bit is up to you. I personally, again, will be waiting for some red days to add to my position. Don't forget that QT, or quantitative tightening, has just now gotten underway, and the first big chunk of that $47.5 billion the Fed is set to reduce its balance sheet by this month doesn't hit until mid-month. And of course, that means that when that happens, it will send ripples through the market. I said this in my last video on ChargePoint, but it's worth repeating again. This bear market is allowing for valuation to be reset. ChargePoint is set to double its revenue on a year-over-year basis and just gave strong guidance for when they expect to turn profitable. The company fundamentals are solid and improving at an exponential rate. Investors with a long-term view, in my opinion again, are getting a golden opportunity to see some pretty significant returns over the next couple of years, and frankly, probably way beyond that, with fairly minimal risk. So really the only difference in my approach with ChargePoint versus, let's say, last year is that moving forward, I will be booking some profit along the way on these 20% or greater rallies and buying back in on market-wide sell-offs. It's a bit more of an active strategy, but so far it's paying off. So there it is. And on that note, this is where I'll leave it for today. Don't forget to drop the video a like if it helped you gain a new perspective and share with others who you think could also benefit from it. For my newcomers, subscribe and don't forget to ring the notification bell so that you too can stay in the know. As a reminder, I post every Sunday. Thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.